All right, get ready, because we're going deep on intelligent investing today.
Yeah.
We're going deep with Benjamin Graham's The Intelligent Investor.
Classics.
I've got the revised edition here with commentary by Jason Zweig.
Nice.
And honestly, some of this stuff is really making me rethink my whole approach.
It's interesting, isn't it?
Yeah.
You think you've got a handle on investing, and then Graham comes along.
Right.
It just kind of like shakes up your whole mindset.
Totally.
It's not about being a genius, he says.
Yeah.
It's about temperament. Who knew?
Like, I always thought I needed to be finding these hot new stocks or timing the market perfectly.
Yeah.
But Graham's saying the real key is patience, discipline, and thinking for yourself, not following the hype.
And that's what I think makes this approach so powerful, even decades later. Especially after the crazy market swings we've seen, recently.
Totally.
Remember that Savile Tire Company Graham talks about?
So, yeah.
250% return on the first day, and then poof, worthless by October.
Wow.
Sounds a lot like some of the meme stock frenzy we've seen, doesn't it?
Totally, yeah. It's like people forgot about the fundamentals and just got swept up in the excitement.
Yeah.
Which brings us to Graham's big distinction, right? Investment versus speculation.
Yeah, he makes it crystal clear. People who invest make money for themselves.
Right.
People who speculate make money for their brokers.
Ouch, but it's true.
Yeah, it's true. You need to know you're buying into a solid business.
Okay.
You're not just gambling on a stock price.
But how do you actually do that? I mean, there's so much information out there. It's easy to get overwhelmed.
Yeah.
That's where this margin of safety thing comes in, right? It sounds kind of like a secret weapon.
It is, in a way.
Okay.
He's saying you need to buy assets for significantly less than their real value. Think of it this way. Would you buy a dollar bill for 50 cents?
Of course.
Of course. That's your margin of safety, that extra cushion that protects you.
So it's not just about finding a good company.
Right.
It's about finding a good company at a great price.
Absolutely.
I get that. But then how do you put it all together?
Yeah.
What does a Graham-approved portfolio actually look like?
Well, for the more passive investor, he recommends a balanced mix of stocks and bonds. He suggests somewhere between 25 and 75% in stocks. Depending on your comfort level with risk and how the market's doing.
See, that's what I like about his approach. It's adaptable.
Right.
It's not like a rigid formula.
Exactly.
He also talks about this thing called dollar cost averaging, right? Isn't that kind of like setting it and forgetting it?
It is. You basically invest a fixed amount regularly. No matter what the market's doing, you end up buying more shares when the prices are low.
Right.
Which can really kind of smooth out those scary ups and downs.
Yeah.
Takes the emotion out of it, which is, a big part of Graham's philosophy.
That makes sense for someone who doesn't want to be glued to the stock ticker every day. But what about those of us who want to be a little more hands-on, do some digging, maybe even outperform the market?
He calls those folks enterprising investors. And he's got advice for them, too. He recommends strategies like buying bargain issues, carefully chosen growth stocks, and special situations. But even then, it's all about finding those mispriced assets. Stocks that are trading for less than they're actually worth.
So like finding a diamond in the rough.
Yeah.
But how do you actually spot those? Is it just about looking for stocks with really low prices?
It's more nuanced than that. Remember, he's all about looking at the fundamentals. One of the things he talks about is finding stocks trading for less than their net working capital. That means you're essentially getting the company's fixed assets for free.
Wow, that's incredible. It's like getting a 2-for-1 deal.
It is.
But that must take some serious research, right?
It does, but Graham shows you how to do it. He provides a framework for analyzing a company's financial strength and understanding their true earnings picture. He even warns against over-relying on the earnings per share that companies report. Because they can manipulate those numbers to make things look rosier than they really are.
Wait, so you're telling me those fancy earnings reports can be misleading?
Sometimes.
Wow.
And Graham was way ahead of his time in calling this out. He exposes some of the accounting tricks companies can use to inflate their earnings.
Wow.
It's all about digging deeper and seeing through the smoke and mirrors.
So we're learning to think for ourselves, spot bargains, not be fooled by accounting gimmicks, But there's still this big elephant in the room.
Yeah.
The market itself, it's a roller coaster. And I know I get caught up in the ups and downs.
Oh, yeah.
What does Graham say about dealing with all those fluctuations?
Well, he's got a really interesting perspective on that.
Okay.
He says those short-term price swings are meaningless. They're just noise. What matters is the long-term value of the business.
So don't panic when your stocks go down, as long as you believe in the underlying company.
Exactly.
Easier said than done.
Right, but Graham debunks this whole idea of trying to time the market. He says it's a fool's errand.
Okay.
Instead, focus on your investment goals, do your research, and tune out the daily drama.
Easier said than done.
Right, but that's where that discipline he keeps talking about comes in.
So it's not about getting lucky or outsmarting everyone else. It's about having a system sticking to it.
Exactly.
And not letting your emotions run the show.
And that brings us back to one of Graham's core messages.
Okay.
Think for yourself.
All right.
Don't blindly follow the herd.
Yeah.
Don't rely solely on financial advisors. And don't get swayed by expert predictions.
Right.
You have the power to become an intelligent investor.
You know, I'm starting to see why this book is considered a classic.
Yeah.
He's not just giving us tips, he's giving us a whole new way of thinking about investing.
He is, and we've only just scratched the surface.
I can't wait to dig in deeper, but first, I think I need to go for a walk and let all this sink in.
Yeah, good idea.
Join us next time as we continue our deep dive into The Intelligent Investor.
Absolutely.
And uncover even more of Graham's timeless wisdom.
It's timeless, it really is.
All right, we'll see you next time.
See ya.
All right, we're back and ready to dive deeper into Graham's The Intelligent Investor. One of the things that really stood out to me was his analysis of market history. He basically takes us through 100 years of ups and downs, showing just how crazy and unpredictable things can get.
It's like he's saying, hey, don't think you're smarter than the market.
Right.
Been doing this a long time. Right. It's going to keep throwing those curveballs.
Like, we all hear about these amazing returns, but he points out there were times when the economy was booming, but stock prices didn't soar the way you'd expect.
He uses that period from like 1950 to 1970 as an example.
Oh, okay.
Think about it. Continued prosperity, prices are going up.
Right.
But corporate profits didn't skyrocket.
Interesting.
He points to things like wages rising faster than productivity, companies needing tons of new capital, which impacted how efficiently they were using that capital.
So it's not always a simple equation of good economy equals buy stocks.
Not necessarily. And that's where he gets, I think, really interesting.
Yeah.
He suggests that in times of uncertainty, investors should be cautious about having too much of their money in stocks.
Okay.
He even advises against having more than 50% in stocks, unless you're super confident and prepared for potential drops.
Hold on, isn't this the guy who's famous for advocating stock investing?
Yeah.
So he's not saying go all in on stocks no matter what.
He's all about adapting to the situation.
Okay.
And he talks about bonds too, although, remember, he was writing this back when interest rates were a whole different ballgame.
He talks about U.S. savings bonds being a good option back then. But those aren't exactly the hot investment they used to be.
Right. But the underlying point is still valid.
Okay.
The choice between short-term and long-term bonds really depends on your individual needs and how much risk you can stomach.
So short-term bonds for safety.
Right.
Long-term bonds for potentially higher returns.
Yeah.
But with more risk. Got it.
Exactly.
But let's get back to those enterprising investors you mentioned earlier, the ones who want to dig a little deeper. What kind of strategies does Graham recommend for them?
He talks about bargain hunting, growth stocks, and special situations, opportunities that might pop up that aren't your typical investment.
Okay.
He even lays out what he considers a real bargain.
So
stocks selling for less than their net working capital.
Wow.
It's like paying for the inventory and getting the whole business thrown in for free.
Okay. That's definitely a deal I'd be interested in, but he's not talking about just any old growth stock, right?
No, he's very cautious about those.
Okay.
He uses the example of Texas Instruments, kind of a classic growth story that got way ahead of itself.
Okay.
The stock price soared, but the earnings didn't keep pace.
Right.
And eventually it crashed back down to earth.
Ouch.
He warns about getting swept up in the hype.
Right.
And ignoring the fundamentals.
Which makes sense because a company can grow really fast by acquiring other businesses.
Right.
But that doesn't always mean it's a good investment.
Exactly. It's like putting lipstick on a pig.
Right. Right.
He cautions investors to be really careful about companies that are on a buying spree. Make sure those acquisitions are truly adding value.
Right.
Not just masking underlying problems.
So it's all about looking under the hood and understanding how a company is actually making money.
Right.
Not just getting caught up in the headlines.
Absolutely.
And that brings us to one of the trickiest parts of analyzing a company. Understanding their earnings.
Right.
Graham was a master at spotting accounting gimmicks.
Yeah.
That can make a company look more profitable than it really is.
He was.
Like, what? Give me an example.
Okay.
Because honestly, looking at financial statements can feel like trying to read another language sometimes.
Well, he talks about one company that reported a big jump in earnings. But it turned out half of that increase came from changing their depreciation method to something less conservative.
Interesting.
It's like they changed the rules of the game halfway through to make themselves look better.
So you need to be a bit of a detective, right?
Yeah. Digging into the footnotes, making sure those earnings are real.
Absolutely.
Not just smoke and mirrors.
He also talks about the importance of looking at a company's cash flow, not just their earnings. Because a company can be reporting big profits on paper, but still be bleeding cash.
Right.
He calls them OPM addicts.
OPM.
Companies hooked on other people's money.
I like that.
And he points to companies like Global Crossing and WorldCom.
Oh, wow.
As examples of companies that got into trouble by playing fast and loose with their accounting. They were growing rapidly, but their underlying businesses weren't generating enough cash to support that growth.
So it's a reminder to look beyond the hype.
Yeah.
Make sure the numbers add up.
Absolutely.
What else does he warn against?
He cautions against companies that are constantly splitting their stock and bragging about it in press releases.
Oh, really? He sees that as a way to manipulate investors into thinking they're getting a better deal.
Right.
When in reality, the value of the company hasn't changed.
So it's about substance over style.
Exactly. Focus on the fundamentals, not the hype.
Okay, so we've got to be on the lookout for accounting tricks, cash flow problems, and stock split shenanigans.
Right.
What about dividends?
Yeah.
Are those always a good sign?
Graham has some interesting thoughts on that.
Okay.
He puts the burden of proof on the company to show why it's not paying a dividend.
Okay.
If a company is consistently beating the competition and growing.
Right.
Maybe they're putting that cash to good use by reinvesting it. But if they're struggling or underperforming, not paying a dividend could be a sign that management is misusing the cash.
So dividends aren't necessarily a must-have.
Right.
But companies need to have a good reason for not paying them.
Yeah, exactly.
What about companies that are hoarding cash? Is that always a bad thing?
He actually sees that as a potential red flag, too.
Okay.
It could mean that they can't find good investment opportunities.
Right.
Which might be a sign of a lack of innovation or growth potential.
Interesting. So it's about finding that balance between reinvesting for growth and returning cash to shareholders when it's not being used effectively.
Yeah.
Does he talk about how shareholders can actually influence
the
company's decision?
He believes shareholders have a right to demand good management.
Okay.
And hold them accountable. He encourages them to get involved.
Okay.
Read those proxy statements.
Right.
Go to shareholder meetings and even team up with other shareholders to push for changes if they see something fishy.
He sounds like quite the activist investor.
He does.
So he's not just talking about buying stocks and sitting back.
Right.
He's saying you have a voice and you should use it.
Exactly.
He wants investors to engage with the companies they own and hold management's feet to the fire, so to speak.
He even warns against companies with overly complex or hard to understand financial statements. That could be a sign they're trying to hide something.
So transparency is key, right?
Yeah.
Investors need to be able to see clearly how a company is managing its finances.
Absolutely. He wants investors to be empowered, not intimidated.
Okay.
Now, remember that concept of margin of safety?
Yeah.
We talked about earlier?
Buying assets for less than their intrinsic value.
Right.
Kind of like finding those dollar bills for 50 cents.
Well, he keeps coming back to that idea throughout the book.
Okay.
He sees it as essential for minimizing risk.
Right.
Especially in uncertain times.
So it's not just about finding a good company.
Right.
It's about buying it at the right price with that extra cushion built in.
He actually says that buying without a margin of safety is speculation, not investing.
That's a pretty bold statement.
It is. And it really highlights the importance of being patient and disciplined, waiting for the right opportunity.
Yeah.
Rather than jumping into something just because it's hot or everyone else is doing it.
Okay, so we've got margin of safety.
Yeah.
We've got our detective hats on when looking at earnings. And we're not afraid to speak up as shareholders.
Right.
What else should we be thinking about?
Well, this might sound obvious, but he emphasizes that buying stock in a public company is like owning a piece of a private business.
Wait, explain that to me. Because when I think of the stock market, I think of ticker symbols and charts, not owning a business.
Right. But he wants you to shift your perspective.
Okay.
Imagine owning a farm.
Okay.
You wouldn't be constantly checking its market value, would you?
No, I'd be focused on how productive it is.
Right.
How much food it's producing.
Yeah.
And its long-term potential.
Exactly.
Okay.
He's saying you should approach your stocks the same way. Focus on the company's fundamentals, their earnings power.
Right.
And their long-term prospects.
Okay.
Not just the daily fluctuations of the stock price.
That's a really helpful way to think about it. It takes some of the pressure off.
Yeah.
Knowing you don't have to react
to
every little blip in the market.
And speaking of the market,
yes,
Graham describes it as a voting machine.
Okay.
In the short term. And a weighing machine in the long term.
I love it. What does he mean by that?
He's saying that in the short term, stock prices are driven by emotions, rumors, the whims of the crowd. It's like everyone's voting on what they think a company's worth.
Right.
But those votes can be based on anything.
But in the long term?
In the long term, the market weighs the actual value of a business, taking into account its earnings, its assets, everything else.
Right.
Eventually, the price reflects reality.
So it's like the wisdom of the crowd eventually wins out, but only if you give it enough time.
Exactly.
Okay.
And that's why he's so adamant about tuning out the noise and focusing on the long game.
Okay, but how do you actually do that?
Yeah.
I mean, it's easy to get caught up in the excitement when the market's going up and everyone's making money.
He suggests having a clear investment policy statement.
Okay.
Basically, a written plan that outlines your goals.
Right.
How much risk you're willing to take.
Okay.
What your strategy is.
That sounds like a good way to stay grounded and avoid making impulsive decisions based on fear or greed.
He also recommends taking advantage of market fluctuations, but not by trying to time the market.
Right.
He thinks that's impossible.
So what does he mean by taking advantage of fluctuations?
He means having a plan for when to buy and sell.
Okay.
When prices drop and good companies go on sale, you're ready to pounce.
So you're being opportunistic but disciplined.
Exactly.
Not just buying randomly. Because something seems cheap.
And he emphasizes having enough cash on hand.
Okay.
So you're not forced to sell your investments at a loss.
Right.
If the market takes a dive.
That makes sense. You don't want to be caught selling at the worst possible time just because you need cash.
Exactly.
So dollar cost averaging, a clear plan, and some cash on the sidelines.
Yep.
Anything else?
He's a big fan of dollar cost averaging, which we talked about earlier.
Takes the emotion out of investing.
It does, which he sees as crucial.
So investing consistently? Regardless of market conditions.
Yeah.
Basically not letting fear or greed dictate your actions.
Right. He wants you to be in control.
Okay.
Not reacting to every headline or market swing.
Okay. This is all starting to make sense.
Yeah.
We've talked about stocks, bonds, managing your emotions, understanding the market.
Yeah.
What about investment funds?
Oh, yeah.
Does Graham have any thoughts on those?
He actually dedicates a good chunk of the book to discussing investment funds.
Okay.
He talks about balanced funds, common stock funds, performance funds, and even closed-end funds, which are a bit of a different animal.
I know there are a ton of funds out there.
There are.
How do you even begin to choose?
Well, he starts by breaking down the different types and explaining their pros and cons.
Right.
Balanced funds invest in a mix of stocks and bonds, which can be a good option for a more conservative approach.
So it's a way to get diversification without having to pick individual stocks and bonds yourself.
Exactly.
Then he talks about common stock funds, which focus primarily on stocks, and have the potential for higher returns, but also higher risk.
Makes sense. More risk, more potential reward.
What about those performance funds he mentions?
Yeah.
Those sound intriguing.
Those were a relatively new thing when he was writing.
Okay.
And he was pretty skeptical of them. They aim for above average returns.
Okay.
By taking on more risk.
Right.
Often focusing on growth stocks or other speculative investments.
So kind of like what we call growth funds or aggressive growth funds today.
Exactly.
Okay.
And he warns that while they might do well in the short term, they also come with a higher risk of losing money.
So don't get caught up chasing the hottest funds.
Right.
Focus on ones with a solid long-term track record and a reasonable level of risk.
Exactly.
What about those closed-end funds?
Yeah.
Those seem different from the others.
They are. Unlike most funds.
Okay.
They have a fixed number of shares that trade on stock exchanges.
Oh, okay.
Kind of like regular stocks.
Interesting.
And because they trade on exchanges, their prices can fluctuate quite a bit.
Right.
Sometimes even trading at a discount.
Okay.
To the value of their underlying assets.
So you could potentially find bargains.
You could.
In closed-end funds if you know what you're looking for. Now, beyond the different types of funds, he also gives some general advice on how to pick and evaluate them.
That's helpful because there are literally thousands of funds out there.
It can be overwhelming.
It is. He emphasizes looking at a fund's long-term track record.
Okay.
Its expense ratio.
Right.
How much they're charging you to manage your money. And the quality of its management team.
Okay.
He wants investors to find funds that align with their own investing philosophy and risk tolerance.
So it's about finding the right fit for you, not just jumping into the hottest fund of the moment.
Right.
Okay.
He also cautions against chasing performance or jumping in and out of funds based on short-term market movements.
Okay.
He's all about consistency and patience.
So find a good fund that fits your goals and stick with it.
Yep.
Don't let the market's ups and downs make you second-guess your strategy.
That's the idea.
Okay.
Now, I wanted to share a story Graham tells in the book.
Oh, okay.
A little anecdote that really stuck with me.
I love a good story. What's this one about?
It's about a guy who owned shares in an American can company back in 1938.
Okay.
The stock market was in a slump.
Okay.
And the share price had fallen quite a bit. The guy was probably freaking out, right?
Yeah, I'd be sweating bullets if my investments were tanking.
But Graham points out that as long as the guy held on to those shares and believed in the company's long-term value, he didn't actually lose anything. It was just a paper loss.
So it's about distinguishing between a temporary dip in the market and a real decline in a company's worth.
Exactly.
Okay.
And he says if the company's underlying value remains strong, the share price would eventually recover.
It's a reminder to have faith in your analysis and not let short-term market noise make you doubt your decisions.
He actually compares owning a stock to owning a piece of a private business. Just like you wouldn't panic and sell your business every time the economy slowed down. You shouldn't panic and sell your stocks just because the market is down.
That makes sense. It's easy to forget that stocks represent ownership in real businesses, not just numbers on a screen.
He argues that the market is there to serve you, not to instruct you. You should use the market as a tool to buy and sell at prices that you believe are advantageous, not blindly follow the crowd.
So it's about being an independent thinker, using your judgment, not letting the market dictate your decision.
He warns against letting emotions like fear and greed cloud your judgment.
Which is easier said than done, right? We're only human.
He suggests viewing market fluctuations as opportunities to buy low and sell high. But only if those decisions are based on your analysis, not emotional reactions.
So be opportunistic, but also disciplined. What about when it comes to deciding when to actually buy or sell a stock? That's the part I always struggle with.
Well, Graham acknowledges that there's no magic formula. But he does suggest focusing on a company's long-term earnings power and financial strength. He cautions against overpaying for growth or buying stocks that are popular just because they've been going up in price.
So it's about being a value investor, looking for those hidden gems that the market might be undervaluing.
He suggests using a variety of valuation metrics, like the price-to-earnings ratio, price-to-book ratio, dividend yield, to get a sense of a company's worth. But it's not just about the numbers.
Right.
You also need to understand the management team.
Right.
The competition, the overall industry dynamics.
He actually provides a checklist in the book.
He does.
Of factors to consider when analyzing a company, which I found incredibly helpful. It's like having a roadmap.
It is.
For doing your research.
He's all about giving you the tools you need to become a successful investor.
Now, beyond individual stocks,
yeah,
he also offers some thoughts on how to approach the overall market.
That's something I'm always trying to figure out.
Right.
Is there a way to predict which way the market's going to go?
Yeah.
Graham's advice is to avoid trying to predict the market's direction.
Okay.
He thinks market timing is a losing game.
So don't try to be smarter than the market. Just ride the waves.
More or less, he suggests focusing on building a diversified portfolio.
Right.
Sticking to your long-term plan and using dollar-cost averaging to invest consistently over time.
So ride out those market fluctuations, don't panic, and keep investing steadily.
He also cautions against getting caught up in the hype and fear that surround market bubbles and crashes.
Which is easier said than done.
It is.
When you're watching your portfolio plummet. Right.
But he urges investors to see those downturns as opportunities. Times when you can buy quality stocks at bargain prices.
So be greedy when others are fearful.
Exactly.
And fearful when others are greedy.
Now, here's where it gets really interesting. Graham dedicates a whole chapter to the psychology of investing.
Oh, this is important.
It is.
I know I've made some bad decisions based on fear and greed.
He acknowledges that investing isn't just about numbers and analysis. It's also about understanding human behavior. How our emotions can trip us up.
He talks about things like overconfidence, confirmation bias, looking for information that confirms what we already believe. And loss aversion, the tendency to hate losing more than we like winning.
Exactly.
He gives practical tips for overcoming these biases, like having a written investment plan, seeking out different viewpoints, staying focused on the long term.
It's like he's saying, know thyself, understand your own weaknesses and tendencies, so you can make smarter decisions.
He also emphasizes the importance
of
patience and discipline.
Building
wealth takes time. There are no shortcuts.
Slow and steady wins the race.
And he cautions against following the crowd or listening to those self-proclaimed experts who claim they can predict the market.
Yeah, exactly.
Think for yourself. Do your own research. Don't believe the hype.
Now, I know we've talked a lot about individual investors. But he also has some interesting thoughts on the financial industry as a whole.
It's a big, complicated world out there. What's his take on it?
He's pretty critical of the industry, actually.
Really?
He thinks it often puts its own interests ahead of its clients.
Wow.
He cautions against relying solely on financial advisors or brokers for advice, and encourages investors to do their own research and make their own decisions.
So be your own advocate. Be skeptical. Don't just blindly trust someone because they have a fancy title.
He also warns against chasing performance. Or investing in complex financial products that you don't fully understand.
Keep it simple. Keep it transparent. Know what you're investing in.
Exactly.
He emphasizes understanding fees and expenses because those can really eat into your returns.
It can.
He also says to be wary of anything that sounds too good to be true. Like guaranteed or risk-free investments.
Those always sound like a red flag to me.
Now, I know you mentioned having a favorite quote from the book.
I do.
What is it?
It's this. The investor's chief problem and even his worst enemy is likely to be himself.
Wow, that's powerful.
Yeah.
It's like he's saying we are our own worst enemies when it comes to investing.
He's acknowledging that our own emotions and biases can sabotage our success.
It's a reminder to be self-aware, to understand our own psychological tendencies, and to develop strategies for overcoming them.
He emphasizes patience, discipline, and a long-term perspective as key ingredients for success.
So investing is more than just picking stocks. It's about personal growth and self-mastery.
Exactly.
And that's why his book has resonated with so many people for so long. All right. We're back for the final part of our deep dive into Benjamin Graham's The Intelligent Investor. You know, one thing that really hit home for me was how he uses real-world examples to drive his points home.
Absolutely.
It's not just theory. He shows you how these principles play out in actual companies.
And case studies are fascinating, aren't they?
Yeah.
He doesn't just talk about, abstract concepts. He takes you inside companies like Penn Central Railroad, which went bankrupt in the 70s, and even the AOL-Time Warner merger.
Oh, wow.
Back in 2000.
I remember that merger. It was huge news.
It was. And to see how Graham's principles could have helped investors avoid those kinds of disasters, it's eye-opening.
It's almost like a cautionary tale, right?
That is.
Learning from the mistakes of others.
Yeah.
But he also highlights companies that did things right, that achieved long-term success by following sound financial practices.
Exactly. It's not just about avoiding losses.
Right.
It's about identifying those companies with strong fundamentals that are built to last.
Okay, so we've got the case studies, but what about those appendices? He includes, I always feel like those are where the real gold is hidden.
You're telling me one of the most interesting ones is his essay on the super investors of Graham and Doddsville.
Okay.
He profiles this group of investors who achieved incredible returns by following the principles of value investing.
It's like proof that his approach actually works, right? And not just in theory, but in practice.
And what's fascinating is that these investors came from all different backgrounds, had different styles, managed different portfolios. But they all shared that commitment to buying undervalued assets and taking a long-term view.
It's like they all had their own unique approach, but they were all speaking the same language, the language of value investing.
He also includes appendices on things like investment taxes, the dangers of speculation, and even a deep dive into a specific company, Aetna Maintenance.
It's like he thought of everything.
He did.
An investor might need to know.
He really did try to cover all the bases.
You know, as we wrap up this exploration, it strikes me that The Intelligent Investor is more than just a how-to guide.
It is.
It's a philosophy, a way of thinking about money and life.
Absolutely.
I completely agree. It's about so much more than just picking stocks.
Right.
It's about making informed decisions. Being patient, not letting your emotions run wild, and building a solid financial foundation for yourself.
He's teaching you how to think critically, how to be rational, how to control your impulses, and how to create, financial security and independence. Those are skills that go way beyond just managing your money.
And he reminds us that investing isn't a game or a competition. It's about participating in the growth of businesses that are shaping our world.
Yeah, it's almost like a responsibility, right?
It is. It's about being a responsible steward of your capital and using it to create a better future for yourself and for others.
Oh, we've covered a lot of ground in this deep dive.
We have.
And honestly, it's given me a whole new perspective on investing.
It's not about getting rich quick or trying to outsmart the market. It's about understanding the fundamentals, being patient, and making decisions that align with your values and goals.
Exactly. And as Graham says, the intelligent investor isn't some kind of genius or market wizard. It's someone who understands the principles of value investing, sticks to those principles, and is always learning and growing.
It's almost like a lifelong pursuit, isn't it?
It is. It's about constantly challenging yourself, questioning your assumptions, and striving to become a more informed and thoughtful investor.
So this deep dive hasn't just given us information. It's empowered us to become more intelligent investors ourselves.
Absolutely.
Think for yourself, do your research, be patient, and stay focused on the long term.
And remember, as Graham says, the market is there to serve you, not to instruct you.
That's such an empowering message.
It is.
Investing doesn't have to be a mystery or a game of chance with the right knowledge and a commitment to those core principles.
Absolutely.
Anyone can become a truly intelligent investor.
Thanks for joining us on this journey.
Yeah. Thanks for listening, everybody.
We hope you found it insightful. And maybe even a little inspiring.
And remember, the journey to financial success
is an
ongoing one. Keep learning, keep growing, and keep striving to become a more intelligent investor.
Absolutely.
Happy investing, everyone.